Hi everyone, this is Daniel. Let's start. Every few years, the stock market shifts in a way most people don't notice until it's too late. In 2026, that shift isn't coming from AI hype, it's not robotics, and it's definitely not crypto. The real force shaping the next 3 years of market returns is something far older and far more powerful: global conflict and how nations prepare for it. Behind the headlines, governments aren't just talking, they're spending aggressively. Military budgets are expanding at a pace we haven't seen in decades, and that spending doesn't slow down when markets fall. In fact, it often accelerates. That's why this group of stocks isn't just about growth, it's about protection. Over the past year, tensions have quietly escalated across multiple regions. Strategic buildups, advanced weapons systems, and large-scale defense planning are no longer theoretical. They're already funded. And here's the key detail most investors miss: defense spending doesn't depend on consumer confidence, interest rates, or election cycles. It depends on national security, which means when markets panic, these companies keep getting paid. In recent months, policy discussions have focused on next-generation defense systems: layered missile detection, space-based surveillance, hypersonic response platforms, and AI-driven battlefield intelligence. This isn't science fiction anymore, it's procurement. One of the most important developments has been the renewed focus on integrated defense architecture: systems designed to detect, track, and neutralize threats across land, sea, air, and space. And building those systems requires more than weapons. It requires data, sensors, software, real-time decision engines. That's where a new class of defense technology companies comes in. Some of these firms aren't traditional arms manufacturers at all. They specialize in analytics, battlefield intelligence, satellite coordination, and autonomous systems. Several of them are already reporting explosive government-driven revenue growth, not because of hype, but because contracts are being signed and expanded. At the same time, the world's largest defense contractors are scaling up production capacity, opening new facilities, and investing billions into next-generation systems. That kind of capital spending doesn't happen unless demand is locked in. Global defense spending has already crossed multi-trillion-dollar levels, and projections show it climbing steadily year after year. Unlike consumer tech cycles, this spending rarely reverses once it starts. Which brings us to the most important takeaway so far. These stocks don't just rise when markets are strong, they hold value when markets break. They act like a shield, not just for nations, but for portfolios. And while many investors chase crowded trades, this theme is still misunderstood. Most people won't notice it until prices are already much higher. In the next part, I'll break down specific companies and sectors positioned to benefit the most, from advanced missile defense to autonomous systems, and explain why some names are far better positioned than others. Because knowing the theme is only step one. Picking the right stocks, that's where the real money gets made. And in part 2, we start naming names. Now that you understand why defense spending is becoming one of the most powerful forces in the market, it's time to talk about who actually benefits. Because not all defense stocks are created equal. Some companies build hardware, others build intelligence, and a few sit right at the center of both. Those are the ones investors need to pay attention to. One of the biggest shifts in modern warfare isn't firepower, it's information dominance. Today's conflicts are won by whoever can gather data faster, process it better, and act on it sooner.
That's why governments are pouring money into advanced analytics platforms that connect satellites, sensors, and weapon systems into a single operational picture. This is where specialized software-driven defense firms step in. These companies don't just supply equipment, they help governments decide, and that capability is becoming non-negotiable. Several firms in this space are seeing government contract revenue grow at rates that traditional industries can't touch. We're talking double-digit and even triple-digit expansion in certain divisions, driven almost entirely by long-term defense agreements. That kind of revenue is sticky. Once embedded, it's extremely hard to replace. Then there are the established giants, the backbone of military infrastructure. These companies specialize in missile defense systems, radar networks, aerospace platforms, and secure communications. Their technology protects airspace, naval fleets, and strategic assets around the globe. What makes them especially attractive right now is scale. When governments decide to expand defense budgets, they don't experiment, they go with proven suppliers. That's why these firms often see multi-year order backlogs worth tens or even hundreds of billions of dollars. And once those orders are booked, future revenue becomes highly predictable. Another fast-growing corner of this theme is autonomous defense systems. Unmanned aerial vehicles, autonomous surveillance platforms, and AI-assisted targeting systems are no longer optional, they're essential. Smaller defense technology companies focused on these areas are growing faster than the legacy contractors, simply because they're closer to the cutting edge. Some specialize in drone platforms, others in electronic warfare, others in secure battlefield communications. Individually, they may look risky, but collectively, they represent the future of defense. For investors who don't want to bet on a single company, there's another approach: broad exposure to the entire defense technology ecosystem. Defense-focused investment funds now hold dozens of companies across cybersecurity, aerospace, data intelligence, and weapons systems. These funds benefit from rapid growth in smaller firms while still anchored by large, stable contractors. Historically, this approach has delivered strong returns during periods of geopolitical tension, often outperforming traditional safe assets. Which brings us to a critical comparison. Gold protects wealth during fear. Defense stocks grow wealth during fear. That's the difference. And as global tensions remain elevated, this theme doesn't rely on optimism, it feeds on necessity. In the next part, we'll zoom out and connect defense spending to broader market forces, interest rates, currency shifts, and why capital is quietly moving away from bonds and into real assets and strategic industries. Because defense stocks don't rise in isolation. They rise because money is moving, and smart investors follow it early. In Part 3, we uncover where that money is coming from and what it means for the rest of the market.
To really understand why defense-related stocks are gaining strength, we need to zoom out, way out. Because this isn't just about geopolitics, it's about where global money is going next. And more importantly, where it's leaving. For decades, government bonds were the ultimate safe haven. When uncertainty rose, investors parked money in long-term debt and waited it out. That pattern is quietly breaking. In recent months, large institutional investors and foreign funds have begun reducing exposure to long-term government bonds. Not loudly, not dramatically, but consistently. Why? Because yields are no longer behaving the way they're supposed to. Even as central banks signal stability, long-term interest rates have shown stubborn strength. That's a red flag. When rates stay elevated despite easing expectations, it often means buyers are stepping back. Fewer buyers mean lower bond prices. Lower prices mean higher yields. And higher yields ripple through everything. Mortgages get more expensive. Corporate borrowing tightens. Growth stocks feel pressure. But here's the twist most people miss. While some capital exits bonds, it doesn't disappear. It rotates. And right now, it's rotating towards sectors that benefit from inflation resistance, government spending, and long-term contracts. Defense fits all three. Defense companies don't rely on consumer demand. They don't depend on cheap credit.
and they aren't hurt when inflation sticks around. Their customers are governments, and governments don't miss payments. At the same time, a weaker dollar environment has quietly boosted hard assets and strategic industries. When currencies fluctuate, tangible production and essential services gain value. Energy benefits, materials benefit, and yes, defense benefits. Because military equipment, surveillance systems, and aerospace platforms are priced globally and funded long-term. Now add one more layer: earnings. Despite economic uncertainty, corporate profits, especially in strategic sectors, have remained surprisingly strong. Analysts continue to revise earnings expectations higher for companies tied to national infrastructure, security, and logistics. Markets may pull back here and there, corrections may happen, but capital doesn't wait on the sidelines forever. It flows towards certainty. And certainty right now looks like this: multi-year defense contracts, backlogs locked in through the next decade, government-backed demand, and rising global security budgets. That's why even during market dips, these stocks tend to stabilize faster and recover stronger. This doesn't mean every defense stock is a buy at any price. Valuation still matters, timing still matters. But it does mean this sector behaves differently than most. When tech slows, defense holds. When consumers pull back, defense advances. When fear rises, defense gets funded. In the final part, we'll bring everything together. I'll explain how to approach this theme intelligently, whether through individual stocks or broader exposure, and what signals to watch so you're not late to the move. Because the biggest mistake investors make isn't being wrong, it's being early without a plan, or right after the opportunity has passed. In Part 4, we talk strategy and how to position for 2026 without chasing headlines. By now, the picture should be clear. Defense stocks aren't a trend, they're a structural shift. But knowing the story isn't enough. What matters is how you act on it, without overpaying, panicking, or chasing headlines. Because smart investing isn't about excitement, it's about positioning. The first mistake many investors make is trying to time the perfect moment. They wait for absolute clarity, for confirmation in the headlines, for everyone else to agree. By then, prices have already moved. Instead, experienced investors build exposure gradually. They enter in phases, they add during pullbacks, and they focus on companies with durable advantages, not short-term spikes. When it comes to defense-related investments, there are two clean approaches. The first is selective ownership. This means choosing a handful of companies deeply embedded in long-term military infrastructure. Firms with recurring government contracts, expanding backlogs, and technologies that are difficult to replace. These businesses don't need explosive growth to perform. They just need continuity. And in a world defined by ongoing geopolitical tension, continuity is almost guaranteed. The second approach is broad exposure. Instead of betting on one winner, some investors choose diversified exposure across defense technology, aerospace, cybersecurity, and intelligence systems. This strategy reduces single-company risk while capturing upside from emerging players, especially smaller firms growing faster than the giants. It's a quieter strategy, but historically it's been incredibly effective. Now let's talk risk, because pretending there isn't any would be dishonest. Defense stocks can pull back during periods of temporary optimism. If peace headlines dominate or markets surge elsewhere, capital can rotate away briefly. That's normal. What matters is whether the underlying demand disappears, and right now, it isn't. Budgets are approved years in advance. Facilities are already being built. Systems are already being deployed. This isn't speculation, it's execution. The biggest danger isn't volatility, it's ignoring valuation and going all in at emotional highs. That's why patience matters. Let the market come to you. Let headlines cool off, let prices breathe, then position with intention. As we move toward 2026, markets will continue to swing between fear and optimism. Rates will move, narratives will change, new trends will fight for attention. But beneath all that noise, one thing remains steady. Nations will continue to invest in security, and investors aligned with that reality will be rewarded. You don't need to predict the future. You just need to recognize what's already unfolding. And the investors who do that early are the ones who don't need luck to win.